You already know how powerful SIP investing can be. But the true magic of investing lies in a combination of an SIP and an SWP, which is short for a Systematic Withdrawal Plan. It's a superb way to generate a regular income from your mutual fund investments. Now, this income could be generated from day one or much later, like 10, 20 or even 25 years down the line. Now, just imagine this. Investing 15,000 per month through an SIP with a 10% annual step up for 25 years will allow you to get 40 lakh rupees per year for 30 years, which at that time would be worth about 12 lakhs per year or 1 lakh per month because of inflation. And what's the best part? You can keep increasing that 40 lakh per year withdrawal to keep up with inflation for all those 30 years. So by the end of it, in total, you would have withdrawn well over 28 crores. And I'll show you how you can do that in just a bit. In this video, I'm going to dive deep into SWPs, how you can use them, and which are the best mutual funds to start an SWP from. Hello everyone, I'm Uday Nadhe. I've been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,000 families make better financial decisions. And on my YouTube channel, I talk about all things in money and personal development. So what exactly is a systematic withdrawal plan or an SWP? Before I explain, if you're serious about investing, I'm hosting a personal finance masterclass on 15th September and you can register for it using the link in the description. In this session, you will get access to 8 proprietary personal finance calculators that I actually use while working with my clients, including several of the Excel sheets that you've seen in my videos. I'll also teach you how to select mutual funds for your long-term goals like retirement, where exactly to invest for short-term goals like going for your dream vacation, and how to avoid getting scammed by insurance companies. I'm excited to share these insights with you, so make sure that you grab your seat through the link in the description because spots are limited. Now let's talk about SWPs. An SWP is quite simply a method of investing. Just like in an SIP, that is a systematic investment plan, where you invest money in a mutual fund on a regular basis, in an SWP, you withdraw money from a mutual fund on a regular basis. Here's how it works. You first up instruct a mutual fund house on how much money you want to withdraw, from which fund, on what date, and for how long. For example, let's say you have invested 10 lakhs in the SBI Balanced Advantage Fund and you want to get about 10,000 rupees as regular income from it. And this is not a sponsored video by any means. I'm going to mention several fund names and none of these fund houses are paying me to say their names. This is just me talking about them to give you an idea. So in this case now, you would simply instruct the fund house, SBI in this case, to start an SWP of 10,000 rupees per month on say the first of every month for 1 year. Once the SWP is registered, and right at the end of the video I'll tell you how you can go about this as well, SBI will sell units from your investment worth 10,000 rupees on the first of every month for 12 months. And then you'll get that money in your bank account within 2 working days. So the 10,000 rupees that you receive is essentially for all purposes a redemption order. But by setting up an SWP, you can schedule that redemption as per your needs. Now let's see how this actually plays out in real life with the actual example of the SBI Balanced Advantage Fund, and I'm going to share an Excel sheet so you understand it better. So here you go. There's a lot happening in the table that I know, but just follow me along for a few seconds. Here in this column that I'm highlighting is the date of where you first invested. So you put in 10 lakh rupees on 1st August 2023 and in return for that you got about 81,433 units. And at that time the fund NAV was 12.28. And then from that very day you start withdrawing money, 10,000 rupees per month for the next 12 months. So you withdraw money every month. Now in that case you will notice a few things here. First up, the number of units that you now have, they start reducing progressively. And because the NAV here, which is the value of the fund, that is increasing, the number of units that you withdraw is also reducing because now every unit is worth much more. So if you think about it, you start off with about 10 lakh rupees and then you withdraw 10,000 per month. So you've totally withdrawn 1.2 lakhs. So in that case, the fund value by the end of that 1 year, it should be lower than 10 lakhs, correct? But here's what happens. If you notice the fund value is 10.77 and that is because the NAV has gone from 12.28 to 14.88, which translates to a return of 21.17%. So even though your withdrawal rate is 12%, The fund has actually grown by about 21%, and because of that, you end up with a higher amount. And that is the beauty of an SWP, that if the fund where you've invested money, that grows at a faster rate than your withdrawal rate, you actually end up with higher money even though you have taken money out of that fund. Now this brings me to a very, very important point. How do you decide how much income can you actually generate through an SWP? Because if you withdraw too much money, too high an amount, the money that you have invested will just get over. Imagine the same 10 lakh rupee investment, but now you withdraw 1 lakh rupees per month. What would happen then? We'll actually see that. So we'll withdraw 1 lakh. And now you'd see that in the 11th month itself, you have now run out of money because your balance turns negative. So you're no longer able to withdraw the amount that you want to withdraw for as long as you want to withdraw. And this has happened at a time when the portfolio, when the fund has actually generated about 21% returns, which is extremely, extremely high. So your withdrawal amount must be lower than the return your investment is generating. That's why the amount that you can withdraw depends on 3 factors. First up, for how many years do you need to generate an income from your investments? Number 2, how much income needs to be generated? And number 3, the expected returns on your investment and its variations. Because if you think about it, in this 1 year, the SBI Balance Advantage Fund generated over 20% returns, but that would not be the case every single year. At times, it could even generate negative returns. So how does that then affect the withdrawals that take place? Now, all these 3 factors are interconnected and you just cannot look at them in isolation. So I'm going to share with you 3 SWP setups so that it becomes crystal clear as to how to use SWPs. The first includes an SWP for financial freedom. And right at the end, I'm also going to share a bonus 4th SWP setup with you that will absolutely blow your mind. It's of a real life mutual fund case study and I'm not exaggerating when I say that. Now let's see how SWPs can be used for achieving financial independence or can fund your retirement. So this is my FIRE or retirement number calculator. And we'll enter a hypothetical age here. Let's say you're 30 years old and your retirement age when you want to retire is 55. So that's 25 years later. And the income that you want during retirement is about 1 lakh rupees. Now, while entering 1 lakh, do not consider inflation because this calculator has inbuilt features where it already takes that into account and gives you the number that you need. Now, let's say inflation is 5% and your life expectancy is 85 years. In that case, you would need 7.18 crores by the time you're 55 to be able to draw this 1 lakh rupees inflation adjusted till you're 85 years old. And by the way, once you sign up for my personal finance masterclass, you can get this FIRE or retirement number calculator along with 7 other such personal finance Excel sheets, including a step-up calculator that we'll now put values in to see how you can get to this 7.18 crores that you would want. So let's say you're starting an SIP of 15,000 rupees and you get about a 13% return on it. The reason I've assumed 13% is because the Indian stock market for a diversified portfolio where you have large, mid and small caps has historically over the past 25-30 years done more than 14-15%. So I've actually assumed a slightly lower rate. And we have a 10% step up. So as your income goes up, you keep increasing and you want this money 25 years later because that's when you would retire. So in that case, you would have about 7.36 crores. And if you remember, we need about 7.18 crores. Now, let's say you do get to that 7 odd crore amount and you're 55 years old. What happens then? And that is when SWPs actually start kicking in for retirement or financial freedom. This 7.18 crores would get invested in a diversified portfolio that has some equities through mutual funds, that also has gold, bonds, maybe some government schemes that are active at that point, maybe some real estate. But the idea is this 7 odd crores is invested and that gives you a certain kind of return of say about 8.5 to 10%, somewhere in between that. And then that 7 crores keeps growing because it's growing by that say 10% every year. But at the same time, you're withdrawing certain amount from it every single year to fund your lifestyle, to fund everything that you need money for, which is what I'm going to show you now in this particular cash flow sheet. It's a part of the retirement calculator itself and it may seem complicated, so I'm going to break it down for you. Just follow where my mouse goes so you know exactly what is happening. So you need this money 25 years later because that's when you want to retire. the year is 2049, you're 55 years old, and what you want is equivalent of 12 lakh rupees, because that's how much money we have entered, right? 1 lakh per month. So that's 12 lakhs per year. But the thing is, 25 years later, that 12 lakhs is going to be worth 40.63 lakhs. So you'll need to withdraw 40.63 lakhs to be able to buy things worth that are 1 lakh today. So just see how inflation plays a role as the years roll. And the 40 lakhs doesn't stay constant, right? Because even in 2049, there will be inflation. So that 40 lakhs will also have to be hiked up, and you would need more and more money every year. So if you look at it, this amount progressively increases as you grow older, to an extent where, your last withdrawal of when you are 85 years old is 1 crore 75 lakhs. If you can again see where my mouse is hovering right now. So that's the impact of inflation, and that's very important to understand when it comes to SWPs and also retirement planning. Now what happens is, as I told you, this 7.18 crores gets invested, and then that grows, in this case, at about 8.75% post taxes. So the 7.18 grows becomes about 7.81, and at the same time, you're withdrawing money worth about 40.6 lakhs from this retirement portfolio that you have built up. So that next year, when you start off, you have 7.4 crores. That again grows by 8.75%, and you're again withdrawing a certain amount, in this case 42.66 lakhs. And that keeps continuing, right? That keeps continuing. So if you notice, initially, the amount by which your money is growing in the portfolio is higher than the 40, 42, 45 lakhs that you're withdrawing. So your investment portfolio actually grows for a while. So if you notice, during all these years, so from 7.18 crores, it has grown to about 9.68 crores. And then it starts reducing, because at this stage, your portfolio, you are taking out much more money from it. You're taking out 80, 85 lakhs to be able to fund a lifestyle worth 12 lakh rupees per year. So eventually, by the time you're 85, you would have 0 rupees. So you go down to 0 by withdrawing everything that you have to fund your retirement. Now I know you may be wondering, why do you need over 7 crores to be able to fund your retirement? Why can't you just invest that in a fixed deposit that grows at 7% every year, and you get that interest? So you get about 50 lakh rupees in interest, and that will fund your retirement. Now, let me actually enter 7% here. Instead of 10% across the portfolio, you get a 7% return. And let's say you're in the 20% tax bracket. Now in that case, the post-tax return is 5.6%, and now you need 10.9 to 11 crores instead of about 7.1 crores, and that is because now your portfolio is growing at a lower rate. So it's essential to have some high growth element even in the portfolio when someone has retired, like equities, because that just provides the kicker where that 10% growth across the portfolio is possible. So of the 100 rupees that, let's say, you have to invest, you invest about 50-60% in equities and the rest across other assets. That's why having only a fixed deposit may not be the best idea, because you need that higher growth rate. Plus there can be a higher taxation on fixed deposits, and I'll explore that in just a bit. In the second SWP setup, let's say you only need money for the next 5 years. And that could be required to pay back a loan, or you just require money for day-to-day expenses until your income stabilizes, or even for kids' education. It could be anything. The usual rules of equity investing apply here, and because 5 years is not considered as long-term while investing in stocks, we ideally don't want to invest in an all-equity portfolio. The approach to take here could be to select a balanced fund that invests both in stocks and bonds, and the rationale for this is very simple. Because let's say you're investing 10 lakh rupees and you want to generate an income from it, and soon after you invest, within 6 months, the stock market goes down by 30%. So now your 10 lakhs has essentially gone down to 7 lakhs, and now you have a lower amount from which you can generate that income. So there could be a higher possibility that you may not have enough money to keep drawing that income that you want. Whereas if you have a balanced fund, which is say investing both 50% in stocks and 50% in bonds, then you're cushioned against that massive fall. So even if the market goes down by 30%, you will essentially go down by around 10 to 15%. So your fall wouldn't be 3 lakhs, it will be about 1 to 1.5 lakhs. That's why you want to go for balanced funds, and I'm sharing two popular examples with you. Both have a very long history, they've been around for a long time. The first is the HDFC Balanced Advantage Fund, and as you can see how it invests its money, only 50% is in equity, whereas the rest is in very safe assets, 28% in debt, 20% in cash. So that's the very safe element of the portfolio. And the second popular balanced fund is the ICICI Prudential Balanced Advantage Fund. And even that only has about 50 to 53% in equity, rest in safer assets. So you can see how that would protect you if the market falls and you've invested in these particular funds. Let's go to my Excel sheet so we can go through a few combinations, and you can get this Excel sheet for free in the link down below so you can work out your SWP calculations. So let's say you have 15 lakh rupees now that you want to invest, and the income that you want to generate is, let's say, 25,000 rupees. In that case, if you withdraw 25,000 adjusted for a 6% inflation, you would still have 2.37 lakh rupees left at the end of 5 years, after having taken out 16.9 lakhs. Now, one very interesting thing that you would see here is that the interest or the return, specifically in this case that I have assumed, is 8%, which is much lower than, let's say, if we go to HDFC Balanced Advantage and see how much it has generated in the past 5 years, which is about 22.2%. The category as a whole, the dynamic asset allocation category, has generated 14.25. So why have I selected 8%? That is because I want to bake into this calculation a certain amount of safety and security. Because again, you don't want to be ideally in a position where you're withdrawing way too much money, way beyond what's suggested, and then at the end you don't have any money left. Because if let's say this portfolio grows by 12%, then you'll have about 5.2 lakhs left instead of half of that earlier on. So it's always good to have higher money because that's a bonus, and not have lower money. And balanced funds make sense for a 5-odd year horizon. If you have a shorter horizon that's less than, say, 2 years, then I think investing in bond funds makes the most amount of sense, because investing in equities just exposes you to a certain amount of risk. Whereas if it's anywhere between 2 and 5 years, you can consider something called as an equity savings fund. The third SWP setup involves waiting for some time before you start withdrawing money. Now, what do I mean by that? So let's say you have 15 lakhs from which you have to draw an income. Then you invest that in a balanced fund and you wait for 5 years. So assuming a 10% return, that has grown to 24.15 lakhs. Now just think about it. We'll go back to our SWP calculator and we'll enter 24.5 lakhs here. You see how that changes the game, right? Initially, at a 12% return, you had about 5.5 lakhs. Now you have 21.9 lakhs. So what does that mean? That means you can withdraw much higher amounts. Let's see how withdrawing 50,000 plays out. There you go. So you have 76,000 rupees left, which is again too close for comfort, but you can then withdraw 40,000 rupees and you will have that comfort level baked in of about 9.24 lakhs. Now this approach of just waiting for some time before you start withdrawing has to be well thought out because you have to plan in advance, but that can significantly boost how your portfolio performs, and it can also significantly protect you against big falls in the market because you've given your portfolio some runtime. And that brings me to the fourth bonus setup that I talked about that will absolutely blow your mind. So this is the HDFC Balanced Advantage Fund. It was launched in February 1994. So let's say someone had invested 1 crore rupees at that time, and I know 1 crore 30 years ago was a huge amount. So don't consider absolute numbers here, because just think of it as you're investing 1 crore today, and if the portfolio does similarly in the next 30 years, how it would look like. So you invested 1 crore in February 1994 and you started your first withdrawal in February 1999, that is after a 5-year runway. And how much did you withdraw? 1 lakh rupees per month, and you increased it by 10% every year to account for inflation. So now in that case, if I go to this table, you would see that in 1994, you obviously put in 1 lakh, but by the time you started withdrawing money from it, the portfolio was almost 1.5 crore worth, which is mind-boggling. So you start withdrawing 1 lakh rupees in the first year, and by the end, in 2024, when you made your last withdrawal, because of inflation, any guesses how much that amount would have been that you withdrew? In August, that would have been 10.83 lakhs because of inflation. So the total money that you have withdrawn over these 307 months is 12.56 crores. But despite that, you have 86.2 crores, believe it or not. This is a real life example of an actual fund and how it has done if you had an SWP in it. The returns this mutual fund has generated is crazy high, 18.77. But that is the power of just waiting for some time and then seeing how it plays out. Now let's say you had not waited at all and started withdrawing right away from February 1994 onwards itself, and how this portfolio would have looked like. So the money that you were withdrawing, because you did not let it run for a while, the money would have gotten over in 2003. So if you notice, the money just gets over in 2003. So that's why if you have an SWP and you have the liberty to wait for some time before you can start withdrawing from it, take that chance, because it's just going to put you in a much stronger position. It's going to give you a stronger footing to draw an income from that portfolio. Now, one of the biggest advantages of having an SWP is potentially lower taxation. Because if you're investing in balanced funds and start withdrawing money after 2 years, your withdrawals are classified as long-term capital gains. So every year, you'll get 1.25 lakhs of tax-free gains. And after that, you'll have to pay a capital gains tax of 12.5% on the profit that you have booked. If you have an SWP from an equity fund, then long-term capital gains tax will be applicable after 1 year of investing itself. On the other hand, in a fixed deposit, the entire interest that is paid to you is always taxed as per your income tax slab. So let's assume that both the fixed deposit and the balance fund are generating 7% annual returns and you're withdrawing it entirely and you're in the 30% tax bracket. In that case, your post-tax returns, as you can see, will be the highest for an SWP. How does it look like for a 20% bracket? Again, the highest for an SWP. If it's 10% or lower, then the FD may seem lucrative if you get a 7% return in both cases. But historically, balance funds over a 5 to 7 year period have beaten fixed deposits. So that's where even if you get a higher return post-tax for an FD at a 7% rate, the balance fund could very well have generated 10-12% returns. So it kind of mitigates the tax benefits there as well. So if you want to set up an SWP, what are the kinds of mutual funds that you should be investing in? In an ideal situation, it should be a diversified portfolio with at least 50 to 60% of your money in equities, that is stocks through mutual funds, and then the rest of the money spread across other assets like bonds, gold, and even real estate. This is ideal because it reduces the risk while investing, which is even more important when you have an SWP coming out from that fund. But having said that, it's perfectly possible to set up an SWP from an all equity fund. If that is what you're thinking, aim to have a slightly lower withdrawal rate, especially at the start. Let your portfolio grow over 5 to 7 years, and then if it has indeed increased in value, perhaps you'll be able to withdraw a slightly higher amount. One important point to remember, not all platforms allow you to set up an SWP. If yours doesn't, then you can set it up via CAMS, KFintech, or directly via the mutual fund website's dashboard. Also with an SWP, you are essentially withdrawing money from your investments. So it does affect the process of compounding because now you have lower money invested than if you had not withdrawn anything at all. But we all need money to live our dreams and live our life. So an SWP could be a wonderful idea to fund those expenses if used smartly. That's it for today. If you're interested in it, register for my masterclass using the link below the like button, and I'll catch you in the next one.